Hello, today we'll discuss on controller of money supply and credit. So you know that when we talk about the money creation, then this one is always the commercial banks. When we talk about the controller of money supply, then this one is always central bank of a country, and for India, Reserve Bank of India. So when we talk about the controller of money supply, then Reserve Bank of India. Okay, so central bank of a country, and for India, this one is the Reserve Bank of India. So now question is how central bank can control this money supply or credit. So number one is repo rate. This is also called the repurchase rate. What is repo rate? So repo rate is the rate. Repo rate is the rate at which central bank lends money to the commercial banks. For example, in case of India, this one is the Central Bank of India, Reserve Bank of India, RBI, and this one is suppose the commercial bank SBI. So repo rate is the rate at which RBI will lend money to the SBI to meet their short-term goals, not long-term, short-term. Okay? So repo rate is the rate at which central bank lends money to the commercial banks to meet their short-term needs. So it means the rate at which RBI will lend money to the SBI. This one is the repo rate. But now how central bank can control money supply through this repo rate? So when Reserve Bank of India increases this repo rate, then it increases the cost of borrowing for the commercial bank. For example, see, so when RBI increases this repo rate to the SBI, then SBI has to pay more to the Reserve Bank of India, and it means increase in cost of borrowing for the commercial banks, for example SBI. So when they will give loan to the public, then the commercial bank has to take more rate of interest from the public. So it will decrease the credit creation process. Okay, so again you can say when RBI will decrease this repo rate, then SBI has to pay more less to the RBI. It means it will decrease the cost of borrowing, and commercial banks can give more loan to the public. So simply, when RBI wants to control money supply, then it will increase repo rate, and when RBI wants to increase money supply, so see here, increase in money supply. If Reserve Bank wants to increase the money supply, then they will decrease the repo rate. And if Reserve Bank wants to decrease this money supply, then they will increase the repo rate. Opposite. Okay, so second one is the bank rate. So bank rate is also same with this repo rate, just a difference. This one is for short term and the bank rate is for the long term. So bank rate is the rate at which central bank of a country lends money to the commercial banks to meet their long-term needs. So same thing, suppose this one is the commercial bank, this one is the RBI. So at rate which RBI will lends money to the SBI. So if central banks wants to decrease the money supply, then they will increase the bank rate. And if central bank wants to increase this money supply, then they will decrease the bank rate. Very simple. So next is open market operations. First, what is open market operations? So buying and selling of government securities by the central bank from or to public and the commercial banks. So in here, see, suppose sale of securities. So if sale of securities, it means central bank will sell these securities to the commercial banks and it will decrease their reserves. Then they can give less loan to the public and it will decrease this credit. And purchase of securities. Okay, so purchase of securities. So purchase of securities, it will increase reserves for the commercial bank, because purchase of securities means central bank will buy securities from the commercial bank and then commercial bank will get cash, and that cash will give to the public as a loan and they can earn, so they can create more credit. So please remember, sale of securities to control the money supply, it will decrease the commercial bank's reserve, then commercial bank will give less loan to the public. And the purchase of securities, it means it will increase the reserve of the commercial bank and commercial bank can give more loan to the public. So next is legal reserve ratio. It means commercial bank has to keep some amount legally with the RBI, and there are two parts. One is the cash reserve ratio and one is statutory liquidity ratio, SLR. So what is CRR? So CRR, it means which portion commercial bank has to keep with the RBI. And this portion commercial banks will keep with themselves. For example, suppose today you came to the bank and you have opened a bank account, you have deposited 1000 rupees. Okay, so out of 1000 rupees, suppose LRR is 20% and another is 80%, they will give as a loan. This one is the different thing we have already discussed. So now you see LRR. Suppose in LRR there are also two parts, one is CRR and another one is LRR. Suppose this one is 4%, this one is the 16%. So it means legal reserve requirements, there are two components, CRR and SLR. So under CRR, which portion commercial bank has to keep with RBI, and this SLR portion commercial bank will keep with themselves. So for example, if CRR is 4%, okay, then commercial bank will keep this 4% with the Reserve Bank of India and this LRR 16% which they will keep with themselves. So this one is the legal reserve requirements. And the last one is the margin requirements. So what is the margin requirements? So this is the difference between amount of loan. This is the difference between amount of loan and value of securities. Okay, value of securities. So margin requirements, what? Amount of loan and value of securities. For example, suppose central bank decided that margin requirements is 40%. Okay, so central bank decided that margin requirements is 40%. Then commercial bank has to give only 60% as a loan. So that's why this is the difference between amount of loan and value of securities. Which one? Borrowers will give against the loan. So if central bank decided that margin requirements is 40%, then commercial bank will give only 60% as a loan. Okay, so now you see how central bank will control the money supply through these margin requirements. It means if they want to increase the money supply, then they will decrease these margin requirements. So it may be, suppose 10%. If 10% margin requirements, then commercial banks will give 90% as the loan. And if central bank wants to control the money supply, then central bank will decide that margin requirements is 40%, then commercial bank has to give 60% as a loan. So this one is the margin requirements, difference between amount of loan and the value of securities which borrowers is ready to give against the loan. Okay, so these are the system how central bank can control the money supply. So repo rate, bank rate, open market operation, legal reserve requirements, and margin requirements. So this it's very easy and simple to understand. But if you have any doubt, then just you let me know in the comment section below, and I will talk to you.